A worn silver coin rests in a laborer's palm. Before sunset, what could this agreed denarius actually mean? Matthew 20 makes that coin the fixed point in a day of uncertain work, rising heat, and repeated hiring. The first laborers accept 1 denarius for the day. Later workers receive only a promise that payment will be right. At evening, the steward pays the last arrivals first. We will test what that denarius meant as wages, silver, tax money, and story. Each receives the same silver denomination as the dawn crew. That equality is public, and the story's surprise depends on everyone recognizing the coin. But silver weight, market purchasing power, and a parable's narrative purpose are not the same kind of evidence. We will examine the hiring sequence, the coin itself, comparative wages, grain prices, taxes, and the limits of conversion. The goal is not a modern price tag. It is a careful reconstruction of what made 1 denarius feel concrete. The evidence comes from the biblical text, surviving coins, papyri, ancient historians, archaeology, and responsible economic comparison. By returning to the vineyard at sunset, we can see exactly where history clarifies the story and where certainty stops. Matthew 21:16 begins with a landowner going out at daybreak to hire laborers. The scene assumes workers could gather where employers might find them, but it does not identify a particular town or harvest date. The first group negotiates. The Greek text says they agreed for a denarian for the day. That detail matters. This is a stated contract within the parable, not a wage statistic covering every occupation and province. The landowner returns around the 3rd hour, roughly mid-morning by daylight reckoning. He offers no named sum, only whatever is right. The uncertainty now belongs to the workers as much as to the audience. He goes again around noon and mid-afternoon, then once more near the 11th hour, close to the working day's end. Each trip lengthens the contrast between time worked and payment received across the entire day. Ancient hours were seasonal rather than 60 identical minutes. Daylight was divided into 12 parts, so an hour stretched in summer and shortened in winter. The sequence still clearly moves from dawn toward evening. When evening arrives, the landowner orders payment. That timing fits Deuteronomy 24:15, which requires a vulnerable hired worker to receive wages before sunset rather than wait for another day. That concern is explicit. The text does not tell us why the final workers remained unhired. It gives one fact: no one had hired them. Anything about age, health, reputation, or family would be invented. The silence is deliberate. Payment begins with the last group, making the amount visible to everyone still waiting. If the first workers had been paid privately and dismissed, the comparison, and therefore the dispute, would disappear. The order matters. Each late worker receives 1 denarius. The early group then expects more, but receives the same denomination. Their complaint concerns unequal hours being treated as equal compensation, not an unpaid contract. The agreement itself stands. The landowner answers that the first worker received the agreed amount. His additional generosity creates the story's reversal. Historical economics explains why the payment is intelligible. It does not exhaust the parable's theological point. What, physically, was a denarius? In the early Roman Empire, it was a small silver coin, commonly around 18 millimeters across and roughly 3.5 to 4 grams when newly struck, before circulation wear. Surviving examples vary because standards changed, blanks differed, and circulation wore metal away. A British Museum denarius of Tiberius minted at Lugdunum in AD 1516 weighs 3.87 grams. Another weighs 3.71. Those specimens show why we should speak in ranges, not pretend every denarius was identical. The parable names a denomination, while any individual coin could be lighter, clipped, worn, older, or recently minted instead. A common reconstruction of minting begins with refined silver formed into blanks. A blank was placed between engraved dies, then struck under a hammer so the lower and upper designs transferred onto its two faces. Hand striking produced imperfect centering and small differences. Those irregularities are evidence of manufacture, not damage added for atmosphere. Coin dies also wore down, cracked, and sometimes left traces shared by multiple surviving coins. Imperial denarii carried authority in miniature. A ruler's portrait, titles, victories, divine associations, or dynastic claims could travel wherever the coin traveled, entering transactions far from the mint through everyday exchange in distant provinces. A Tiberian portrait denarius is often used to illustrate gospel-era money. It is a historically plausible type, but we cannot identify the exact design imagined in Matthew 20 or claim one museum coin was the parable's coin. The reverse figure on a familiar Tiberian type has been identified in several ways, including Livia, Pax, or another personification. Even catalogs preserve that uncertainty, reminding us not to turn a debated image into a settled fact. Judea's money supply was mixed. Local bronze coins, older issues, Tyrian silver, Roman and provincial currencies could overlap. A person might calculate in one denomination while handling another coin through exchange at changing rates. Archaeological finds before AD 70 do not show Roman denarii dominating every Judean market. That does not erase the Gospel's denarian. It warns us against imagining a uniform pocket full of Roman silver everywhere. The denomination was broadly intelligible in the Roman world, and Gospel traditions also place a denarius in the imperial tax controversy of Mark 12. Yet literary recognition is not the same as archaeological dominance. This distinction keeps the evidence balanced. The text clearly uses a denarius. Surviving coins show its form. Regional archaeology shows a more complicated circulation pattern than the phrase Roman money might suggest on the ground. Now return to the market square. A day laborer differed from an estate manager, tenant farmer, artisan, enslaved worker, or soldier. Each relationship could involve different pay schedules, food allowances, obligations, and bargaining power. Seasonal agriculture could require extra hands for digging, pruning, harvesting, carrying, or pressing. The parable's vineyard setting is economically plausible, but it does not specify which task the workers performed that day in the narrative. Hiring by the day transferred risk toward the worker. A permanent employee might expect continued work. A day laborer could secure income only after being selected, completing the task, and receiving payment at day's end. That vulnerability is strongly suggested by the command to pay before sunset. The law's concern makes sense when delayed wages could immediately disrupt food purchases, debts, lodging, or other near-term household needs that same evening. Still, vulnerability does not let us calculate a universal poverty line. Some workers had land, kin, stored grain, secondary trades, or obligations we cannot see. Others may have had almost no cushion at all. The denarius in Matthew therefore works as an agreed full-day wage in this story. It should not be expanded into the claim that every unskilled worker everywhere always earned exactly one denarius as a rule. Ancient wage evidence survives unevenly. Papyri from Roman Egypt preserve estate accounts, receipts, contracts, and tax records, but Egypt used its own monetary system, and its surviving documents come from particular districts and dates. Those papyri often distinguish cash wages, rations, task payments, and employer-paid obligations. Two entries that look numerically similar may represent very different real compensation once food, season, and taxes are considered across the same season. Roman Egypt is valuable because dry conditions preserved records that Judea rarely preserves. It is also dangerous if treated as a direct price list for every eastern province. Region must remain attached to every comparison. The surviving Egyptian series shows agricultural wages changing across generations and tasks. That variation supports a modest conclusion. Ancient labor markets were real, negotiated, and locally conditioned, not governed by one timeless biblical wage table. Military pay offers another comparison with built-in limits. Tacitus reports mutinous legionaries in AD 14 complaining about 10 asses a day and demanding a denarius, alongside grievances about harsh service and deductions from their soldiers' pay. A Roman soldier's pay was not a casual vineyard wage. It belonged to long service, military discipline, official accounting, and possible deductions for equipment or supplies. The comparison shows scale, not equivalence between institutions. One denarius was conventionally related to 16 asses in ordinary reckoning, although military accounting could use older conventions. Even the internal arithmetic of Roman money depended on context and institutional practice inside each system. Grain prices seem promising because grain was basic, yet a price means little without a unit, quality, date, market, transport cost, and whether the record describes retail sale, tax assessment, state purchase, or estate accounting. Roman-Egyptian papyri provide many wheat prices, but their artaba was a regional measure, and their drachmas belonged to Egypt's currency system. Translating those figures straight into a Judean food basket would create false precision. The safest use of the papyri is comparative. They show that wages and grain prices can be studied together, while also revealing rations, taxes, and local institutions that make a single coin-to-loaf formula unreliable. Silver content is the first measure, how much precious metal the coin contains. It helps compare coin standards and debasement, but people did not buy bread by melting every denarius and weighing its silver. Purchasing power is the second measure, what the accepted coin could obtain in a specific market. That value shifted with harvests, transport, scarcity, season, regulation, and the buyer's access to wholesale or retail prices. Narrative role is the third measure. In Matthew 20, the denarius marks the dawn agreement, the evening payment, and the visible equality of the workers. Its literary function does not require a complete household budget. Confusing these measures produces confident errors. Silver value cannot alone reveal food security. A grain estimate cannot include every expense. And the parable's equal coin cannot be reduced to a modern wage policy proposal today. Taxes add another pressure, but not one simple bill. Roman provincial subjects could face land taxes, personal assessments, customs, tolls, rents, and local obligations, while the Jerusalem temple tax belonged to a different institution. In Mark 12, a denarius is requested during a dispute about the imperial tax. The coin's image and inscription make imperial authority visible. That episode shows tax symbolism, not that every tax everywhere cost one denarius. Papyri and inscriptions from across the empire document assessments, receipts, exemptions, and collections. They also reveal administrative diversity. A taxpayer's burden depended on status, property, locality, and the particular levy being collected in that system. For the vineyard laborer, taxes belong among possible household pressures, not as a number we can subtract from the parable's coin. Matthew gives no tax bill, rent contract, family size, or market basket at all. This is why exact modern dollar conversions fail. A modern currency amount combines today's wages, productivity, housing systems, transport, taxes, and consumer markets. Structures radically different from those of the first-century Mediterranean in basic structure. Converting by silver price asks what several grams of silver cost now. Converting by labor time asks what 1 day of work earns now. Converting by grain asks how much staple food the wage might buy. Those methods produce very different answers because they measure different relationships. Selecting the largest or smallest figure for drama would not recover the ancient economy. It would only reveal the converter's preferred comparison alone. A cautious reconstruction stays qualitative. One denarius could represent a meaningful day's cash wage, useful for immediate purchases and obligations, yet insufficient evidence for comfort, starvation, class status, or annual income across a lifetime. If this kind of evidence-led reconstruction helps you see familiar passages more clearly, subscribe to World Behind the Verse. Now we return to the public payment at sunset that gives the coin its force. At sunset, the steward does not distribute abstract value. He places the same recognizable denomination into different hands. The late workers can count it, the early workers can see it, and the comparison requires no hidden calculation. The first group's expectation rises only after they observe the last group's payment. The sequence turns information into conflict. Equal coins seem to imply that longer labor should now receive a larger visible amount. The landowner does not deny their heat or hours. The text preserves their complaint about bearing the day's burden. Economic realism makes that complaint understandable, even while the narrative refuses their expected conclusion within the story. The answer distinguishes contract from gift. The first workers receive what was agreed. The owner then claims freedom to give the same amount to the last. History can clarify the transaction without deciding the theology for us. Matthew frames this parable with sayings about the first and the last, following Peter's question about reward in Matthew 19. The vineyard scene therefore participates in a larger argument about status, recompense, and divine generosity. That literary frame prevents a narrow reading. The story uses recognizable labor relations, but it is not a surviving payroll regulation, an estate manual, or a complete program for setting wages in every society. At the same time, calling it a parable does not make its economics decorative. The agreement, repeated hiring, prompt payment, public order, and single denomination are the mechanisms that produce the reversal at the climax. The historical setting also sharpens the emotional stakes. A missed hiring opportunity could matter. Same-day payment could matter. A full-day worker could reasonably compare hours. None of that requires us to invent desperation or certainty. The coin's imperial portrait adds another layer of ordinary complexity. A laborer could receive value guaranteed by the same empire that taxed provinces, stationed soldiers, and broadcast rulers' claims through metal images across daily life. Yet Matthew does not pause over the portrait. In this parable, the denarius is not primarily a lesson about Caesar. Its immediate work is to make the wage agreement and final equality materially precise. The archaeology keeps us from flattening Judea into Rome. Mixed coinage, long circulation, local bronze, and regional silver remind us that ancient economies could share units while exchanging a variety of physical monies in practice. The papyri keep us from flattening wages. Cash might be joined by rations. Tasks differed. Taxes could be assumed or not. Records cluster in places where preservation happened. Silence elsewhere is not uniformity across regions. The military evidence keeps us from flattening pay scales. A legionary's complaint can illuminate Roman monetary language, but soldiers, harvest workers, artisans, and tenants occupied different institutions with different risks and rewards over time. And the grain evidence keeps us from flattening purchasing power. Food prices moved through harvest conditions, transport routes, storage, quality, and local measures. One neat conversion would conceal the very history we are trying to recover. So, what did a denarius buy in Jesus' world? The honest answer is not one basket. It bought different things in different places, while remaining a substantial and widely understood unit of silver account. In Matthew 20, what matters most is more specific. One denarius is the agreed compensation for the first workers and the unexpected full payment granted to those hired near day's end, despite unequal hours. That coin was small enough to disappear in a closed hand, yet large enough to organize a whole day's expectations. Its material modesty and narrative weight belong together. That contrast drives the entire scene. History brings the scene into focus by limiting our claims. We can describe the coin, the workday, prompt payment, comparative evidence, and economic pressures. We cannot reconstruct the worker's exact household accounts for any worker. Theological interpretations differ over grace, Israel, discipleship, reward, and the reversal of rank. What remains certain is that the parable builds its challenge through an economically recognizable agreement deliberately exceeded by generosity in the story. The denarius does not supply a modern salary chart. It gives the story a hard silver edge, a contract honored, expectations exposed, and equal coins placed where every worker can see them at sunset. Which everyday object from Scripture should we reconstruct next? An oil lamp? A fishing net? A measuring basket? Or something else? Tell us in the comments. Subscribe for the next evidence-led journey behind the verse.